The Fox City SCORE chapter and WHBY are pleased to bring you Biz Talk, a chance for you to hear from entrepreneurs and professionals as they share their experiences from starting to sustaining growth. Learn the skills needed for your business to be successful. If you missed anything, you can catch the Biz Talk podcast at biztalkwithscore.com. And now from the Myron Construction Studio, it's Biz Talk on WHBY.
Good morning and welcome to Biz Talk. I'm Terry Finch, one of the hosts this week. And we'll talk more about SCORE later in the show. But before we do that, I'm going to introduce you to our co-host this week. It's Rick Sense. How are you doing, Rick?
I'm doing well, Terry.
Welcome to the show. And our guest this week is longtime sponsor Kurt Heling from Heling and Associates. And Kurt, welcome to the show.
Hi, Terry. Hi, Rick. Good. Always good to talk to you.
Good to have you on.
This is a annual show where we get you in a couple weeks after the end of the tax season. So let's start with that. What were some of the key takeaways that your clients were seeing as they had you work through their 2023 taxes?
Well, one thing that we saw a lot of this year were, especially on the individual tax side of things, were either lower refunds or situations where people who normally got refunds were actually owing federal taxes this year. And it came as kind of a sticker shock for a lot of them because of the fact that there were some changes made. And these changes go all the way back to the 2018 tax changes that came into play where where we went from having a standard deduction and a flat amount for exemptions with kids and dependents. And now we have a larger standard deduction, so most people don't itemize anymore. And then we have a situation where you've got credits for the children, either $2,000 or $500, depending on their ages. With that, the federal tax withholding tables changed as well. We're just starting to see the effects of this now, though, because when we went through COVID, there were a lot of additional tax credits that came out and additional child tax credits and things like that that kind of masked some of the things that were going on in the background with these withholding table changes. Now a lot of those are gone, and so we're seeing the effects of these withholding table changes. And so people need to review their W-4s for withholding and make sure that they've got enough withheld. I mean, I've seen people, I'll give you an example. I'll see somebody with a W-2 for $80,000 and they've got maybe $4,000 in withholding. That's only about 5%. Well, if they're in a 12 or 22% tax bracket, that math doesn't work very well. So it's important, and a lot of people, their pay stubs are online. They don't actually see a pay stub unless they go look for it, but it's worth taking a look at a couple times throughout the year to make sure that you're getting enough withholding out. Otherwise, you're going to run into one of these situations where you're looking, expecting a refund, you end up actually owing money because a lot of it goes back to how the W-4s are calculated. For instance, if you put down a husband and wife each making $80,000, they put down that they're each married, and they each put down that they have 2 kids. Well, when it comes time to do the tax return, they've been withholding as if they had 4 kids when they really only have 2. So they've got to be in sync. The husband and wife have to be in sync together with their withholdings. Each spouse has to compare what do they have in withheld compared to the other one, and take a look at this as a family married filing joint tax return and what the effect on that is going to be.
If they do this and have to say they go from getting a large refund to paying, is there any potential for penalties as well as paying the normal amount owing?
Possibly. And the reason I say that is because there's an item out there called underpayment penalties. And what underpayment penalties are made up of is you're required to either cover the previous year's income tax or 90% of the current year's tax. Well, you don't always know what 90% of the current tax is going to be, but you know what the year before's tax was. So there's a line item on the tax return for 2022, 2023 that you can look at and say, this is what the actual total tax was. That's the amount you need to cover. If you're short, by more than $1,000, then you're going to be subject to that underpayment penalty. And as interest rates go up with everything else, interest rates go up with this also, and they're talking 8% interest on this right now. So we're talking real money potentially.
Okay. And when a person is looking through their withholding, especially for people with higher incomes, is that a time maybe to just give your accountant a call and talk to them a little bit about this too if they don't understand it?
Yeah, because we've got tax planning software. We can take the pay stubs and project them out for the year and see where somebody's going to fall in from a withholding standpoint, and combine both pay stubs for each spouse if it's a married filing joint situation, as well as their other investment activity, and if they've got interest, dividends, capital gains, if they've got rentals, whatever it might be, bring the whole thing into a tax plan and say, okay, here's where you're at now, here's where you're going to end up at the end of the year. And here may be some changes you need to make. Otherwise, you're going to end up owing money. So here's some things to think about.
Okay. Earlier before the show, you were mentioning another way that people have learned to adapt and adjust to taxes. And you were talking about some of the healthcare and retirement spending. Could you tell our listeners more about that?
Well, one of the things that I've seen more and more over the last couple of years is the early retiree people, and I'm talking about people between the ages of 60 and 65. And if you think back years ago, most people worked right up till age 65, and then they retired and they got on Medicare. The reason they had to work right up till age 65 is because they would have had to cover the cost of their health insurance otherwise, if they retired early. And the cost of, over-the-counter health insurance being a couple $1,000s a month, that wasn't a bill that they wanted to pay every month in most cases. Now what we're seeing is a group of people, and I've seen this in a number of situations, where they're able to retire between 60 and 65 because if they've got their finances set up properly between Roth IRAs and non-qualified, non-IRA type investments, interest-bearing accounts, for instance, they don't have to start Social Security yet. If they've got that set up properly, that they can pull money or have access to money, but can keep their adjusted gross income low enough, they're going on marketplace health insurance. And they're going on marketplace health insurance and paying $1 a month for health insurance. And I've seen people with 7-figure net worths literally paying $1 a month for health insurance. And you look at it and you go, fundamentally, this doesn't seem right, but legally, it is 100% legal and, frankly, to be encouraged if you can get yourself set up properly.
So, and as we talked earlier, too, it's interesting that many of the people who absolutely hated the healthcare market who are now taking advantage of this opportunity, too.
I'm going to keep the politics out of it, but yes.
It's hard to keep the politics out of most stuff, but in this one, the law is the law. You follow the law, and if you're following it, nobody should be holding you anything against you for it.
Exactly, because it's a situation where, again, you think about the people that are in a situation where they can retire early. They've probably been very successful at their jobs. They're probably highly intelligent people, and those are the types of people that usually are able to sock away a fair amount of money over the course of their careers. And they usually work with somebody on an investment from an investment standpoint as well as a tax standpoint, and make sure that they're set up for success down the road. And this is one of those situations where they can do it.
Okay. So any other last comments on the 2023 tax season and things you were seeing for the year?
Well, the other thing we're seeing is a ton of extensions on our end of things, just because things have gotten complicated enough and the reporting requirements are such that what we used to be able to push out in an hour and a half to 2 hours is now taking maybe 3 hours to push out. And if you multiply that over the course of 1,000 tax returns, that adds up over the course of time. So we've got more extensions than we've had in the past, but we do plow through them. From a staffing standpoint, we're up to snuff that way. We could always use more preparers. So SCORE members out there, if you're interested in preparing tax returns, this is an unsolicited request. I've already hit Bob Molitor up. I already have one of your SCORE people working for me literally as we speak.
Yeah. So when you look at taxes and the potential that at the end of 2025, we have a massive change in the tax code. Is it going to get any less complicated?
It won't get any less complicated. So here's kind of the timeline of how things are going to work. We just got done with the 2023 tax returns for in early 2024. This is an election year. Election gets held in November. Sometime in early January, we may have an inauguration or a renewal or, renewal with current administrations. Either way, it's going to take at least a year for them to put anything together to propose for what's going to happen after these tax rules expire at the end of 2025. So it's going to take at least a year to find out by the end of 2025 what 2026 and beyond is going to look like. They can go, the tax rates and brackets themselves can go up, down, or stay the same. I haven't had anybody yet say that they're going down. They might stay the same. They might go up dramatically. So at this point, it's a real crapshoot as far as how that's going to work. I can tell you that the complexity of it is not going to go away. There's just from the administrative standpoint of things and how things intertwine, it's going to be as complicated, if not more complicated than ever.
That is a trend that every developed country around the world is seeing, and you're getting to the point where despite the IRS offering free tax services, it's going to be harder and harder for people to take on their taxes on their own because they're going to miss a lot of opportunities if they do.
It really is. And to give you an example of that, I just had somebody in the other day that, used TurboTax the last few years, and then they had a situation come up this year that her sister referred them over to us, and I took a look at it, and it was more of a state situation where for the state, you're allowed to deduct health insurance that you pay out of pocket and your Medicare. They hadn't done that. She says, well, TurboTax didn't ask me that. So that's one of those things. And these canned software programs, if they offer a state approach to it, a state return, most of the time it doesn't do a very good job of it. The IRS free file that you mentioned does not address state income taxes. It's only federal, so you still have to get your state done, unless you're in one of the states that doesn't have an income tax. So you've still got that aspect of it as well. And that's one of those things where, a software company in California really doesn't care too much about Wisconsin tax rules. So they probably don't put as much time and effort into it.
Okay. So we're at the perfect spot for our first break. You're listening to Biz Talk with SCORE on WHBY, and we'll be right back after this.
Good morning and welcome back to Biz Talk with SCORE on WHBY Radio. I'm Rick Sentz along with co-host today, Terry Pinch. And our guest is Kurt Heling from Heling & Associates, and we'll get back to Kurt in just a moment. First, let me just spend a few moments talking to you about Fox City SCORE. Fox City SCORE serves an 8-county area with offices in Appleton, Oshkosh, and Fond du Lac. We have about 45 volunteer mentors, each an expert in their field, and they offer entrepreneurs no cost and confidential mentoring. Those areas of expertise that they specialize in include IT, social media, marketing, cash flow, accounting, strategic planning, workflow, HR, retail best practices, and many, many others. In order to register for a no-cost and confidential mentoring session and or to learn more about the Fox City SCORE chapter, please visit our website at score.org/Fox Cities. You can learn more about how the SCORE chapter can assist you with starting and or growing your business, and you can complete an online application for a mentoring session. Simply complete the online form and submit it to SCORE. Within a few days, the SCORE mentor will be contacting you to set up a meeting. So remember that SCORE is no cost and offers experts who can offer you assistance in many different areas. To get started, again, please visit our website at score.org/Fox Cities. To support small business people, Fox City SCORE is always looking for new mentors. If you have experience that you would like to share with others, we'd love to talk to you. We welcome volunteers with experience in all aspects of business. Small business owners need your help, and your experience can make a real difference to their success. Go to score.org/Fox Cities, click on the volunteer button, and fill out the short application, and we'll get back to you to explain more. So thanks again for listening to Biz Talk this morning, and now back to the show. Kurt, we kind of touched on this in the last segment, but the idea of making taxes easier is something that seems like in my lifetime we've been promised more than we've heard about other opportunities in life. Most recently comes to mind is when Paul Ryan used to be speaker. One of the last things he did while he was in that role was to pass tax reform. And I remember we were told that we'd be able to get it done in no time, even fill it out on a postcard and we'd be done. Can you maybe talk to the listeners about why that's not really the case? Why, even though there's reform, it doesn't really seem to make it any less easier, or any easier, I should say, to do our taxes?
Yeah, I remember that back when they were talking about being able to, they'd send out these postcards and that's all you would need to file your taxes. Well, there was one year where they actually had a page to the return that was basically the size of a half page. But what they did is they took and made 3 subschedules to it then right away first, because they took a lot of the things that was on the old 1040 and just moved it to these subschedules. Mm-hmm. So it was just a matter of shifting paper, for lack of a better term. But think about a situation where you've got a couple of married filing jointly. They each have a W-2. They each have withholding. Taking out any other interest, dividends, capital gains, or anything like that, or any businesses or any rentals or anything, just with their W-2s. And now they've got 2 kids. Okay, how old are the kids? Well, if they're young enough, they get a $2,000 credit for it. Well, part of that might be refundable. Part of it might go against their withholding. How are they young enough that they're in daycare? Okay, now you got a daycare form you got to fill out. Oh, they're older? Okay, well, now you only get a $500 credit. But are they in college? Okay, now you got a college form. You get an American Opportunity Credit, or if you've taken that too many times, now you got a Lifetime Learning Credit. You just expanded your tax return by 10 pages just with a married couple with 2 kids. So to say you're going to simplify it isn't, unless you're going to take away all those credits too, which would lead to a lot of screaming, you're not going to be able to simplify it. It just conceptually isn't realistic.
So people should be really thinking closely and listening carefully to when they hear those type of proposals of what it really is how it might impact their time on their taxes each year.
And I think the biggest thing there is, take it with a grain of salt at the time of year that it's brought out. If it's brought out in an election year versus, at any other point in time. But the other thing to keep in mind with it is, as these things come through, you still need to get beyond what's on the surface and get into the details of it, just like anything. Find out what's really in there, and talk to a professional and find out when they propose these kind of changes, how is it going to affect you? And a lot of times I don't even like to talk about it in proposal standpoints, because you're speculating at that point. I usually don't even like to take a look at those situations until we know what the final rules are, because that's really the only time where you know what you're actually dealing with, because these things change literally right up to the last minute that these things are signed.
2 follow-up questions to that. First, if I understand right, too, oftentimes the rules are written at a pretty high level, and then is it the IRS that's determining how they really apply? Is that the case too?
Well, and what happens and where the IRS gets involved with it is the Congress comes up with the proposals and the rules. The IRS has to take those rules and figure out, okay, how are we going to take these rules and make it into form such and such, and make it flow so it comes out the way that the rules are written. And that takes a fair amount of time too.
Well, and the second part of it that occurs to me as we talk is, how does that affect Wisconsin and the way the state of Wisconsin taxes? So if there's changes at the federal level, is that impacting your Wisconsin taxes as well?
Maybe. It depends if the state decides to go along with it or not. And the state doesn't always decide to go along with it. For instance, health savings account, the state of Wisconsin didn't go along with for several years. So there was always a federal to state adjustment for that. There's depreciation issues that the federal will have. For instance, bonus depreciation applies for federal. The state has never adopted bonus depreciation. So you can have differences there for your business. So there, on the flip side of that, the state has subtractions that you're able to take on their side that aren't as easy to get on the federal side. So there's always some differences between, I shouldn't say always, but in many cases there's differences between federal and state returns.
Okay, so we're at a time to take our second break. You're listening to Biz Talk with Score on WHBY, and we'll be right back after these messages. Welcome back to Biz Talk. Before we get back to Kurt Heling, I want to give you a bit of an update on some educational opportunities. We talk about it occasionally, but if you go to our website, it's score.org/Fox Cities, and click on the Workshops and Events tab near the top, there's an incredible library of opportunities there, literally in the thousands of different courses you can take. I'm going to talk about a few of them now. The first thing I'll talk about are some national live events that you can sign up for free. The two of them I wanted to mention were, one is how to write a one-page business plan. That's on May 14th at 12 o'clock Central. And that's important because not everybody needs a full business plan. And quite frankly, one of the best ways to learn how to write a full business plan is start with the one-pager and then expand from there. But that's a good one for business. Second one is how to create a LinkedIn B2B business-to-business marketing strategy. And that's on May 16th at 12. But if you go off to the left on that online event piece, you'll see where you can pick between national and local. And there are literally hundreds of events coming up in May that you can sign on and sign into, and for most cases free, learn a lot of things. So there's one that Denver and Southern Colorado SCORE chapters offering. It's called Organizing Your Time for the Small Business Owner. That's May 15th. And another one of the hundreds out there is called Funding Your Business. And that's on May 16th, and that's from the Mid-Florida SCORE chapter. So those are some of the live events, and again, there's hundreds of them. Most of the live events end up as recorded webinars, so you can also go back after the fact if you couldn't go live. And so there's a lot out there. And then one of the biggest sections is on online courses. And there we have things like our startup roadmap, simple steps for exiting your business, and getting started with e-commerce, among others. But there are a series of 4, 8, 12 webinars to help you in certain areas. So again, go to score.org/Fox Cities and click on the Workshop and Events tab, and you'll find incredible resources out there with a lot of different courses for you to learn about. So now we'll turn back to Kurt. And Kurt, let's talk a little bit now about some updates on things we've talked about in the past. So the one was a new name to me, FinCEN. Can you talk about that a little bit?
Well, FinCEN is an organization that is under the Department of Treasury. It's the Financial Crimes Enforcement Network, which sounds pretty serious. It's the guys with the guns. And why that's relevant to our business owners is now any LLCs that are formed throughout the country are required to register with FinCEN. And they need to go to the FinCEN website. And the reason for this is because FinCEN is trying to find what they call the beneficial ownership interest, BOI. And what beneficial ownership is if you think about some of these LLCs, you hear about these LLCs that are owned by other LLCs that are owned by other LLCs. FinCEN's trying to figure out who the actual owners of all these LLCs are, who the physical person is, or who the corporation is that actually owns these things. And some of them may be domestic, some may be foreign. So that's what they're trying to find out. And, the listeners might be thinking, well, I've just got a little LLC. It's just me, myself, and I. And so this doesn't apply to me. And nothing can be further from the truth. Those are exactly the people that need to register for this. Because if you think about the big companies, the publicly traded companies, they've already got all their information because they've got 5K filings and 10K filings and all those sorts of things that they have to do. They know who the beneficial owners are there. They know Elon Musk is a beneficial owner of Tesla, for instance. What they don't know is who's the beneficial ownership of your little LLC. So you have to go on the FinCEN website, go through, get them your information. You'll have to update. You'll have to provide a proof of ID, usually a driver's license. Upload that. For the average business owner, that maybe it's even if it's just a one person single member LLC or a 2 or 3 person LLC partnership or S corp. Most of the time, it takes 10 minutes to go through and do it. It's usually not that complicated. It's a matter of getting all the information, getting the identification up there. But they really want to find out who actually owns these LLCs. And so that's what they came up with. That needs to get done by the end of 2024, or they can start fining you $500 a day. Now, that has gotten a lot of national attention, and there are actually lawsuits and court cases going against it because that's a pretty severe fine for forgetting to file something or not filing something erroneously, maybe not even knowing that it's a requirement. So there's some lawsuits going on with it. My suggestion is it's simple enough, it's easy enough. They've already got your information on your tax return, but this is another way for them to follow that up. Most people should just go on and file it. One other thing that is separate from that, and I've had people say this, is, well, don't they have that information when we set up our LLC through the state of Wisconsin? Well, no, they don't, because the federal does not go to the state of Wisconsin and ask this information. So Wisconsin has its own filing system that needs to get registered every year. Typically for LLCs, they would send out these little blue cards, and with that, there'd be a code on there. You go online, you register, you give them your $25 every year. Now, and then if you didn't do it, they would send you an orange card saying you were late and charge you $50. And if you miss that one, then they would say that you're administratively dissolved, and then you don't have an LLC anymore. The state is changing as well. So they are changing over to an email system to notify people about their LLC registration requirements. So in addition to the FinCEN form, go on and check your state filing status. I had somebody do this, and they found out that they had been administratively dissolved a couple of years ago already. So didn't you ever get the blue cards? I don't know. Wife takes care of the mail. I never saw it. Well, the wife probably thought it was junk mail and tossed it or something, or somebody moves and it doesn't move with them, whatever it could be. So now you go online so now that person's got to get their LLC reinstated. Now they're doing that all via email. Well, we know the problems with email. If it comes through, it goes to spam, whether or not you get it or you see it and you don't know what it is, so you're afraid to click on it. It comes from the Wisconsin Department of Financial Institutions, so it should be something like that, which should normally stick out to a business owner. But again, it could go as spam. So if you haven't seen this, go on to the Department of Financial Institutions website, check it out, make sure you register, and make sure you're up to date with Wisconsin as well.
And one thing I'd say is people just need to be aware that the people that are working for the Wisconsin Department of Financial Institutions, for the IRS, et cetera, don't have the time to make exceptions, and they hear every excuse in the books. So sometimes it's quite hard for them to feel sorry for you, if I want to put it that way. So the best way to handle it is do your homework, get it done on time, and not fall on the mercy of the IRS, because I don't think I've ever heard of that before.
That's kind of an oxymoron.
So it's interesting too, as Wisconsin does this, you'll still notice their old-fashioned website and emails as they come in and kind of look at it and say, that doesn't look like it's very modern. But at least they're trying. I'll give them that much. But anyhow, so one of the other things that we talked about last time, and it was really in the news pretty heavily, was the employee retention credits. We're not hearing as much about it now, but I don't think it's been resolved yet. Could you give people an update on that?
Yeah, so the employee retention credits, the ERCs, were credits that were brought up during COVID. As the name implies, if you kept your employees through COVID and you qualified based on either a reduction in revenue, or you were shut down for some reason, or had some other qualification, and those qualifications were very narrow, you were eligible for this credit. So in 2020, so you're eligible for this based on 2020 wages. And so the filing deadline for that literally just passed, because you could have qualified for that right up through April 15th of 2024. Okay, so we just lost that deadline. For 2021, it would still be available to someone, but I don't know that I've ever seen a situation where somebody qualified for it in 2021 but didn't qualify for it in 2020. So that said, the 2020 deadline's passed, 2021 is still available. But what happened, because there was so much fraud with respect to this, and you heard these advertisements about you can get $26,000 per employee for any employee you had in that time period, and nobody really thought too much about the details behind it or the qualifications behind it. There was so much fraud going on with it that the IRS literally suspended processing employee retention claims back in September of 2023, so a little over 6 months ago. They are very slowly starting to reopen that. And I say very slowly because there is much more scrutiny going on with reviewing these applications for the credit. They're reviewing the calculations more closely, and making sure that, number one, you're not including, for instance, owners who should be excluded from those wages. If you got PPP, that has to get factored in and is a reduction of your credit. So there's those things that are going into the calculation. They're looking at that, and they're also looking at, did you really qualify? Did you have a reduction in revenue? Was your business literally shut down by the government? Or did you fall into one of the other narrow criteria, such as, the supply chain breakdowns? For instance, I had a client that got supplies and materials out of Canada, couldn't cross the border. That counts. If your supplier was literally on the other side of Wisconsin, probably not so much. So, some of these things that were being used as qualifications really weren't legitimate qualifications. So they're scrutinizing that quite a bit. In light of that, what the IRS did is they set up a program, and in that program, if you reviewed your employee retention credits, maybe you had gotten the money already, and then you took your taxes to your accountant, and the accountant looked at it and said, you didn't really qualify. There was a program where you could literally pay the money back. You had to name the name of the company you used. So if you used one of these third-party providers, you had to name names and literally pay the money back. But you only had to pay back 80%. And the reason you only had to pay back 80% is because these companies usually kept 15, 20, 25% of the credits. They did it all on a commission type basis, or as opposed to a flat fee. And that's where a lot of the fraud came in, because it just naturally opens up. The more we can get for these people, the more that we get for ourselves. So you didn't have to pay them on the full credit. You only had to pay 80%, which is usually about the amount that the taxpayer got. You also didn't have to pay back the interest. or any late payment penalties or anything like that. So it's a good program, but it ended in March, and I don't think it's going to come back and get renewed. For a while there was talk that it might get extended. That hasn't happened. It's been gone for a month now, and it's kind of just gone dormant. That said, there's a lot of people in 2023 that applied for this, and they never got the money yet. An issue with that is if you applied for the refunds for these credits, one of the things that happened was you also had to amend your 2020 and 2021 tax returns because you cannot take a deduction for those wages if you got the credit. So here's a conundrum. You applied for the credit. You have to amend your 2020 tax return. You have to amend the tax return and pay back the amount of tax based on the amount of wages you claim the credit on, but you haven't gotten the money yet. So you might end up paying money back for a credit that you haven't even gotten yet. That's a real conundrum for people. So there are some people that are saying it's just not worth it. I don't want to do it. You can rescind your application. There's a program for that. You can rescind the application, and then it's no harm, no foul. It didn't happen. Go on as you were. If you got the money and you want to pay it back because you found out that the third-party provider you were using was not doing things properly and you got more than you should have, you can still pay it back, but you're going to have to pay back interest, you're going to have to pay back penalty, and you're going to have to pay it back in full, including the amount that the third-party provider took as commission. So you're going to be out some money that way. But it's one of those things you look at it. It's better than the alternative of getting it audited and having to pay it back. And that audit period can go. The statute of limitations on this is not your normal 3-year statute of limitations. They're talking 5-7-year statutes of limitations on this. They're still trying to figure this. They're still making up the rules on this as they go. But it could be. So if you think about it, even if it's a 5-year statute of limitations and you applied in 2023, that takes you out to 2028 on a credit that applied to 2020. How good are your records going to be 8 years after the fact? So it's still a mess. It's still out there. It's not getting the headlines that it did for a while with the fraud and everything. But it still needs to get dealt with. And it's still a thorn in the side of a lot of accountants, I'll guarantee you that.
Okay, I'm sure we'll be talking about that regularly. One other item for this segment, talked a little bit about cloud-based record keeping before the show, and you wanted to talk and give an update on some things around QuickBooks and how that affects cloud-based record keeping.
Yeah, so QuickBooks is the 800-pound gorilla in small business accounting. I mean, they are the big one, and there's not a close second at this point. So, number one, they get to kind of call the shots. And so they have gotten, quite frankly, into it. The owner of them has gotten greedier and greedier as long as they go along. They're in a situation now where they, as of the end of May, they are going to be discontinuing anything from 2021, QuickBooks 2021 and earlier. They're not going to be supporting that anymore. And you need to move to either QuickBooks Online or a QuickBooks subscription-based service. It can still be desktop, but it's going to be subscription-based desktop. It's not going to be, pay $400 at Walmart or Sam's and take it and go. It's going to be a regular monthly fee or annual fee, however you want to pay it. And this is even if you don't have any other employees. In the past, they would do this, but if you didn't have employees, you could kind of work around it a little bit. And you didn't have the payroll function to worry about, so it wasn't as big a deal. Now it's getting to be a big deal because not only are they not supporting this, but the other issue with the desktop side of it is, as you transfer files, for instance, somebody transfers us a file, it's getting harder and harder to secure those programs from the standpoint of malware and things like that. So somebody sends us a file, it could potentially have malware in there, and it's harder to keep that out of the software at this point also. So there's getting to be more and more online. Not necessarily a bad thing. The QuickBooks Online has gotten much better over the last 4 or 5 years and much more user-friendly. The issue becomes, if you close down the business, if you sell the business, whatever it might be, they still have your data. So you want to make sure that when you end your QuickBooks subscription, that you have your data downloaded, so that you've got the download of all your information. Otherwise, let's say you get audited in 2 years, or some other situation comes up 2 years down the line, you need to get at that information for some reason, you're going to end up having to pay all the back fees to be able to access that. That's not a good situation.
Okay, we're at the perfect spot for our last break. You're listening to Biz Talk with Score and WHBY, and we'll be right back. Welcome back to Biz Talk with Score. I would like to thank the sponsors and donors who bring Biz Talk with Score to you each weekend. We couldn't present Biz Talk without their generous support. Thank you to Heling Associates. Thank you, Kurt. Heling Associates helps small businesses and individuals not just prepare tax returns, but plan for taxes, thereby helping you minimize taxes for this year and beyond. Heling Associates, personal connection, positive results. A special thank you to the Business News for promoting our program in the biweekly business newspaper serving Northeast Wisconsin. If you haven't already subscribed to the Business News, you should. The paper is delivered bi-weekly and contains relevant and useful information about the business community in Northeast Wisconsin. We'd also like to recognize the David L. and Rita E. Nelson Fund within the Community Foundation for the Fox Valley region for their generous donation in support of Biz Talk and Fox City Score. Again, we could not be successful without these sponsors, and we greatly appreciate all they do for us. So, Kurt, before we go on, could you let people know how they can find Heling Associates?
They can go to our website, helingandassociates.com, HELING, Associates, all spelled out, .com. You can also call 920-886-2241. Our office address is 1977 American Drive, so we are just off 41 in Fox Crossing. Not quite Neenah, not quite Appleton. So very local, though, so we can help out people in the area.
Okay. So as people are they're done with the 2023 taxes, and as they start looking forward into 2024 and 24 tax season, what should they be thinking about, and how should they be working with you?
Well, one of the things that we talked about earlier is review your withholdings. Make sure you've got enough to cover. We can help do a projection on that. We will do a review of somebody's tax return if they did it themselves, or if somebody else prepared it for them. If they want us to take a look at 2023 and give our thoughts, we'll definitely do that. Typically, we'll do that without any charge, and if there's an amendment, then we'll figure out what that cost would be. But the best thing you can do is plan for it. Talk to your accountant, whether it's us or somebody else, and just keep in contact with them on items that are coming up that could help your own personal financial situation.
Okay. And as you look forward into 2024 and 2025, what are you thinking about for Heling and Associates and where you're heading?
Well, we've got a lot of new people in the office right now. We're getting things organized with them, and really hoping that we can keep this core group together for a number of years in the future. It's we had some turnover last year, but now with this year, with this core group, if we can keep this group together, we should be able to expand quite nicely.
And during the pandemic, I know there was a number of CPA firms in the area that closed down essentially.
Yeah.
Are you seeing overall that there's supply to meet the demand for CPAs, or is that still an
No,
issue?
there is a shortage of CPAs like you would not believe, especially younger ones. I was talking with an investment rep the other day, and he was looking for somebody, younger CPAs to partner with. He was younger himself. I said, good luck finding one, because they literally aren't out there like they were 20 years ago. A lot of them have aged out, and gone out of business, sold out, maybe sold out the bigger firms that are more expensive for the average person to go to. So there is a shortage of CPAs out there. I could do a whole show just on that.
And so, for people out there listening and you're thinking about a career, there is a career in the accounting world where they need a lot of people, and where there's demand and not supply, you will see wages go up over time. So just be thinking about that when you're thinking about careers.
And because of that, that's part of the reason our fees have to go up, unfortunately, as well, because we have to pay our people as well. So,
And once again, thanks, Kurt. It's always great to have you on the show.
always a pleasure to be here.
For listeners, you can go to our website at biztalkwithscore.com and hear this episode and previous ones as well. We really appreciate you listening in, and have a great week. We'll talk to you next week. Bye.